$15 trillion has vanished from gold, silver, and cryptocurrencies together. Gold dropped 15%, silver plunged 38%. Just in the past day, over 15 trillion disappeared. That's equivalent to half the US GDP evaporating in 24 hours. We've seen the initial Sigma 10 occurrence in finance records. Statistically, this event shouldn't occur even once across the universe's existence. The matrix is truly glitching, and it won't halt. $500 billion gone from crypto in 3 days. 2.5 billion in leveraged long positions liquidated recently. This ranks as the 10th biggest wipeout in crypto records. Bitcoin fell 13%, slashing almost 265 billion from its value. ETH tumbled 25%, losing 91 billion. XRP declined 22%. Sol dipped 23%. For newcomers, I'll clarify. I don't offer trading signals, coaching, or classes. The veterans here understand. Don't approach me for buy or sell advice. We analyze deeply. We examine every angle. This is for self-reliant minds who blend this data with their own decisions. If that's not you, perhaps markets aren't suitable. If you're not subscribed there, you're lacking live insights. We talked about a drop to $86 or less being feasible, and it occurred. Long-timers know. Watch out for imposter profiles stealing my breakdowns with false stats. I'm not accountable for them. Check the username. Stick with the authentic one since I provide balanced views. No panic, no hype. I've never pushed trades or favored one view. I deliver neutral facts and urge independent thinking. Know your position and act autonomously. Now, key points to grasp. On Friday, metals tanked. Silver down 31%, gold off 13.6%. 7 trillion vaporized from precious metals solely. I revealed the key evidence. JP Morgan shut 633 silver shorts right at the nadir. They nailed the timing. They departed. Then this weekend, crypto gets hammered. Bitcoin, ETH all plummeting. Is this orchestrated? Spillover effect? Or the framework crumbling live? Let's link the pieces. Friday's 25% silver plunge wasn't solely due to Kevin Wersch or USD power. A core factor, sure, but also deliberate rigging leveraging that as a trigger. CME hiked margins to 11% on Jan 28. Long speculators at $25,000 margin abruptly needed $66,000 at $120 silver, triggering sales. JP Morgan's Feb delivery figures indicate they issued 633 contracts at Friday's $78 close, implying big institutions covered shorts via purchases from pressured sellers at lows. Meanwhile, physical buyers in China and India held firm at any cost. If JP Morgan unloaded a huge short position amid forced sales by acquiring from overextended specs between $78 to $90, they cashed out near bottoms. Physical owners in China/India wouldn't budge. This creates a risky bounce setup with reduced shorts to limit upside. That's metals. Now, stats show 3/4 of you aren't subscribed. If this candid, raw take is clarifying your market outlook and boosting true confidence, then subscribe. It signals the genuine group is expanding. And if it helps, comment with OG John AG. That input means a lot. It keeps me and the crew aligned on your priorities. If it's not your style, no issue. I avoid fake metrics. I'm for those seeking reality, not the sanitized, disconnected tales from traditional outlets. Now, crypto. Why the plunge today? Bitcoin under 79,000. It's purely liquidity driven. 3 clear liquidation surges hit about 1.3 billion in 12 hours. In a market with inconsistent depth, high leverage causes price voids. Add fickle crowd moods flipping from peak optimism to despair, amplifying volatility. Michael Saylor's approach is 1.8% from red on Bitcoin Stash. Holds 712,647 BTC at $55.72 billion. Bought average $76,038. At 126,000 high, value was $81 billion despite 70,000 less BTC. Below 74,600, Sailors underwater. Big mental barrier. Compare wipeouts. October 10 crash, 19.1 billion liquidated. COVID, 1.2 billion. FTX, 1.6 billion. Today, 2.51 billion. 10th largest in crypto annals. Right after record metals dive. See the pattern. Here's the mind-blowing video that reshapes it all. 15 trillion instantly purged from gold, silver, crypto. Same period, news bombards with Epstein docs and WW3 alerts. So, where'd the 15 trillion end up? It can't evaporate. Someone grabbed it amid distractions. Markets aren't merely tweaked, they're fixed. This is assault on citizens. On WW3 notes, Trump stated he positioned forces and vessels toward Iran if no pact with Israel. Qatar's FM Mohammed bin Abdul Rahman reached Tehran with alleged final U.S. note to Iran's supreme leader Ali Khamenei. Tensions rising quick, markets dumping assets on global risks. First 2026 U.S. bank sank. Initial failure in 7+ months. Mirrors 2008 start. Minor banks first, then cascade. Outcome? Trillions lost. Countless households ruined. System far weaker than claimed. Most folks utterly unready for incoming storm. 3 trillion zapped in moments. Not routine swings. The markets aren't merely manipulated, they're outright rigged. Leading financial experts have warned that tighter conditions could lead to additional collapses among banks, hedge funds, and crypto platforms. We'll see what actually happens. Now, let's break down what Monday might hold. 2 main possibilities. Bearish scenario first. If we're dealing with a widespread liquidity crunch moving from metals into crypto and then equities, Monday risks even greater destruction. Asian sessions kick off earliest. Sharp downward gaps in China, Japan, and Hong Kong would signal trouble ahead for Europe, followed by the US. Contagion accelerates, triggering fresh crypto liquidations as traders wake to heavy losses and rush to sell. Margin calls intensify across every asset class. Should Michael Saylor dip underwater on his Bitcoin holdings, that headline alone sparks extra dumping. Rumors of further bank distress, following the Metropolitan Capital failure, would shatter remaining confidence. Everyone races to cash, dumping everything. Liquidity vanishes even faster. Iran-related tensions might flare up over the weekend. A military clash, strike, or any escalation in war risks would spark outright panic at the open. Oil surges, equities plunge, and risk-off sentiment takes total control. The $15 trillion already wiped out could balloon to $20 to $30 trillion amid cascading sales. Key point for precious metals. If this wave stems purely from margin-driven liquidations and cash demands, gold and silver might face another beating Monday, despite their safe haven status, just as they did Friday and over the weekend. Early crisis stages often see indiscriminate selling while people hunt for dollars. The true safe haven demand typically arrives in Phase 2, but Phase 1 can drag on for days or weeks in severe situations. The CME might raise margins once more Monday, forcing additional metal sales and liquidations. Paper prices could sink further while physical premiums surge. Shanghai premiums already exceed 43%. Should COMEX slide more while Shanghai stays steady or climbs, that gap might reach 50%. Eventually, the COMEX pricing mechanism could lose all trust. Reaching that point would inflict serious pain on paper holders. That's the grim Monday outlook. Now the bullish scenario. If JP Morgan and other major banks successfully close their shorts near the lows, short interest drops sharply, removing heavy downward pressure for the next rally. Physical owners in China and India won't budge below $78 to $90. They're simply not selling. February delivery demand remains strong at 2,514 contracts. Supply stays constrained. If Asian markets steady Monday, liquidations halt, and margin pressure eases, a sharp, powerful rebound becomes likely. Shorts get squeezed, physical remains scarce. Those 43% plus Shanghai premiums highlight how detached paper prices are from actual supply-demand dynamics. The recovery could arrive swiftly and fiercely as covering shorts collide with insistent physical buying. This sequence has played out historically. Huge flush followed by explosive bounce. China's export restrictions effective January 1 are tightening supply further. India soaked up roughly 25% of worldwide output in 2025, with very stubborn demand. Physical market basics remain extremely strong. Once paper selling exhausts and weak holders get shaken out, the upward trajectory faces reduced obstacles. Mining equities might double in the coming 4 to 6 months once clarity returns and the bull phase restarts. Crypto could rally Monday if the liquidation cycle concludes. 3 waves totaling $1.3 billion may have purged most over-leveraged bets. Bitcoin stabilizing at $79,000, or better, climbing toward $82.85, without Saylor underwater would restore some trust. Crowd psychology could pivot from deep pessimism toward tentative hope. Liquidity flows back in, lifting prices. Iran tensions might cool if Qatar's mediation yields progress. No weekend military events and successful diplomacy would remove the war premium. Risk-on sentiment returns, sparking broad rebounds. The twist. If evidence points to intentional manipulation, J.P. Morgan covering shorts at the floor, $15 trillion vanished amid distractions like Epstein stories and WW3 hype, then the orchestrators may have finished their work. They flushed weak hands, covered positions, and reset the board. Now they allow the rally to unfold. Monday turns green everywhere as the bull market's next chapter starts. What I'm tracking closely. Shanghai futures open Sunday evening, our time. If Shanghai silver stays solid or climbs while COMEX is shut, physical demand isn't crumbling. A hard gap lower following COMEX would indicate worldwide, genuine selling pressure. The Asian Open heavily influences Monday's direction. Bitcoin's weekend performance, holding $79,000 firmly or pushing to $82,000 to $85,000, is positive for Monday. Dropping below $75,000 with Saylor underwater is negative. Crypto moves are currently the best gauge of Monday's risk mood. Weekend Iran developments, strikes, incidents, or escalations, equals bearish. Diplomatic breakthroughs or calm equals bullish. Geopolitics drives markets hard at these levels. Banking updates, fresh rumors of trouble, emergency weekend sessions, or FDIC interventions elsewhere equals bearish. If metropolitan capital proves isolated with no further failures, stability holds up better. So, bottom line, 3 core points. Roughly $15 trillion erased across gold, silver, and crypto. Historic first 10 sigma event for metals. 10th biggest crypto liquidation wave on record. This isn't routine, it's systemic strain. JP Morgan closed shorts at Friday's bottom. Crypto bled all weekend. Monday question. Does selling persist, or has it peaked? Monitor Shanghai Sunday night and Bitcoin throughout the weekend. Extreme physical paper divergence. Shanghai premiums over 43% while COMEX tanks. Chinese and Indian physical owners won't sell at these levels. Delivery requests at 2,514 contracts. With JP Morgan out and physical so constrained, remaining shorts face serious danger on a rebound. Continued Monday liquidations could push paper lower before fundamentals take over. Several triggers colliding at once. First bank collapse in 7 months. Heightened Iran risks with forces mobilized. Media sidetracked by Epstein and WW3 narratives. Markets are rigged, beyond simple manipulation. Monday's path hinges on Asian Open, crypto steadiness, Iran headlines, and bank spillover risks. Bearish. Ongoing liquidations, margin pressure, fear. Bullish. Shorts covered, weak hands gone, sharp reversal launches. The big unknown. Was Friday weekend the ultimate shakeout before a powerful bull surge, or the opening act of a broader systemic breakdown? JP Morgan's bottom exit points to engineered flush, yet $15 trillion gone, bank issues, Iran threats, and crypto chain reactions suggest something larger fracturing. Monday's start will reveal the direction. Do your homework. Know the dangers. If you're heavily leveraged in metals, crypto, or equities now, this setup crushes positions. Margin calls ignore narratives. But if your positioning is sound and you grasp the situation, Monday might deliver the year's biggest chance, or signal much deeper trouble ahead. Stay alert. Follow the numbers. The coming 24 hours will clarify it all. Trade with reason, not emotion.